just under. I'm gonna have some Metamucil with creatine, fasting until lunch. A little bit of fiber. Was just doing a little YouTube short earlier, so got that done. Boom. Yo, what's going on, DNI? No meditation this morning. We're gonna do some studying in the morning, and we'll flip the meditation to the evening. Oh, there we go. I just didn't get enough studying in last night, so I'm just trying to chunk it out. Morning and evening, and early evening session. My basketball tournament. Good for you. That's awesome. So as always, 2 scoops of creatine, a little bit of Metamucil this morning because I don't want to. Some days I just don't want to eat till lunch, so. I'm gonna go back into the office. I'm gonna log in, doing a mutual funds course for to get back into banking. I'll probably read aloud, show you guys the text, and yeah. All right. Allergy medicine, Flonase. There's so much pollen mindset, fam. Oh my god. I'm crazy. It's crazy in the morning. Okay. Okay. Now, let's do our little review. And then I'll take you guys with me driving to work in the next little while. So we got about a 20-minute session to read or so, and then we'll hit the road. Into the office we go. Alrighty then. Alright, laptop on. I'll do the reading on here. Oh. I just gotta check where I got to last night. 6-14. So chapter 6-14. Hey, Jonathan Forrest, welcome. You haircut around the same. I got one. Oh yeah, nice. Yeah. Like the fade and everything. Yeah, I love it. Yeah, Michael Jordan in the background. And then check this one out. This is my inspo. Arnold Schwarzenegger. My wife got this for me a while ago. It was his famous double bicep pose that he used to do. Yeah. Totally. Yeah. Sweet one. And then check this out. There's MJ. Yeah. I saw it in Walmart. I'm like, I have to get that photo because he's super motivating. his discipline and working towards his goals. Okay, let's dive in. Mm-hmm. Last night we got a little bit of a study session in, like for the chapter reading, but definitely not enough because it was just getting too late and I was gassed from that workout that I did. Here we go. Okay, here we go. So, register retirement savings plans. Registered retirement savings plans are available to individuals to defer tax and save for retirement years. Annual contributions are tax deductible up to allowable limits. Income earned in the plan accumulates tax free as long as it remains in the plan. So it's just a way of pushing paying your taxes till later. Essentially, there are two types of RSPs, single vendor RSPs and self-directed RSPs. There are no limits as to the number of plans a person can hold. Funds can be transferred tax-free from plan to plan if the taxpayer investor so desires. This is accomplished by completing a transfer document with the trustee of the new plan. The documents are then forwarded to the original plan's trustee. Single vendor plans. In these plans, the holder invests in one or more a variety of GICs, segregated pooled funds or mutual funds. The investments are held in trust under the plan by a particular issuer, bank, insurance company, credit union, or trust company. To qualify as acceptable investments, healthy life with good habits, for sure. Absolutely. DNS. To qualify as acceptable investments for an RSP, either single vendor or self-directed pooled funds must be registered with the CRA. So, for example, this is speaking from Canada, how investments work for tax. Anything that's tax related, you have to register like your SIN number with the CRA, social insurance number. And then if you're from the US, then it's social security number. Their products are a bit different than Canada, but similar. Like principles are similar. In single vendor RSPs, no day-to-day investment decisions are required to be made by the holder. There may be a trustee fee charged for this type of plan in addition to any costs incurred for purchasing the investments themselves. Self-directed plans. In these, holders invest funds or contribute certain acceptable assets such as securities directly into a registered plan. The plans are usually administered for a fee by a Canadian financial services company. One advantage of self-directed RSPs is that the investors can make all investment decisions. Another advantage is that while there are rules with respect to allowable content, a full range of securities may be held in these plans, including GICs, money market instruments, bonds, equities, and mutual funds. Investors may also hold direct foreign investments in these RSPs. There are special features that the investor should understand about an RSP account. First, an RSP is a trust account designed to benefit the owner at retirement. Withdrawals from an RSP are subject to a graduated withholding tax, and such withdrawals must be included in income in the year withdrawn. More tax may be payable at year end, depending on the income level of the taxpayer. Second, an RSP cannot be used as collateral for loan purposes. Contributions to an RSP. There is no limit to the number of RSPs an individual may own. However, there is a restriction on the amount that may be contributed to an RSP on a per year basis. The maximum annual tax deductible contributions to an RSP an individual can make is the lesser of 18% of the previous year's income and the RSP dollar limit for the year. From the lesser of the above two amounts, deduct the previous year's pension adjustment and the current year's past service pension adjustment are a result of being part of an employer-sponsored a registered pension plan. The pension adjustment and the and the past service pension adjustment are reported by the plan's member administrator. The pension adjustment and the past service pension adjustment reduces the amount an individual contribute to an RSP. To ensure the maximum annual contribution on all pension and tax deferral plans combined is not exceeded. Add the taxpayer's unused RSP contribution room at the end of the immediately preceding tax year. The RSP dollar limit is $31,560 in the 2024 taxation year. The limit is indexed to inflation each year. The contributions must be made in the taxation year or within 60 days after the end of that year to be deductible in that year. Individuals can carry forward unused contribution limits indefinitely. So it's a really good way to minimize your taxes when you file your income tax. So using RSPs. And again, hit that subscribe button if you're new here. I go live daily for meditations, workouts, and most recently, study with me. Earned income for the purpose of RSP contributions may be simply defined as the total of total employment income, less any union or professional dues, net rental income, and net income from self-employment, royalties from a published work, or invention and research grants. So it says, some alimony or maintenance payments ordered by a court, disability payments from CPP or QPP, supplementary employment insurance benefits, such as top-up payments made by the employer to an employee who is temporarily unable to work for parent or adoption leave, but not the employment insurance benefits paid by Human Resources or Social Development Canada. Plan holders who make contributions to RSPs in excess of the amount permitted by legislation may be subject to a penalty tax. Over contributions of up to $2,000 may be made without penalty. A penalty tax of 1% per month is imposed on any portion of over contribution that exceeds $2,000. A plan holder may contribute securities already owned to an RSP. According to the CRA, this contribution is considered to be a deemed disposition at the time the contribution is made. Consequently, in order to calculate the capital gain or loss, the plan holder must use the fair market value of the securities. The fair market value is the price at which the property would sell for on the open market at the time of contribution as the proceeds from disposition. Any resulting capital gain is included in income tax for the year of contribution. Any capital loss is deemed to be nil for tax purposes. This type of contribution is called a contribution in kind. All right, example. Mr. Wu bought 100 mutual fund units of Growth Fund Inc. at a price of $10 for a total value of $1,000. 2 years later, the units have increased in value to $20 per share. Mr. Wu decides to contribute the units to a self-directed RSP when the net asset value of the units is $20. The contribution to the RSP would be the net asset value of the fund. So the contribution would be $2,000 to his RSP. His RSP would now hold the units. Because Mr. Wu had an accrued capital gain of $1,000, $2,000 net asset value minus the $1,000 cost, $1,000 gain, he must include the capital gain in his taxes for the year, even though he still owns the units. Spousal RSPs. Spousal RSPs. A taxpayer may contribute to a spousal RSP, which is an RSP registered in the name of a spouse or common law spouse, and still claim a tax deduction. If the taxpayer is also a plan holder, he or she may contribute to the spouse's plan only to the extent that the contributor does not use the maximum contribution available for his or her own plan. Sophie and Nigel are married and contribute to RSPs. Sophie has a maximum contribution limit of $11,500 for her own RSP. Yo, what's going on? But contributes only $10,000. She may contribute $1,500 to Nigel's spousal RSP. Nigel's RSP contribution limits are not affected by the spousal RSP, which is a separate plan. Therefore, Nigel in this example would have two plans, one for personal contributions and one for contributions made by Sophie on his behalf. So now it's another way to maximize your contributions to an RSP. Unless converted to a registered retirement fund, or a registered retirement income fund, or used to purchase certain acceptable annuities, the withdrawal from a spousal plan is taxable income to the spouse, not the contributor. Since the spousal RSP belongs to the spouse in whose name it is registered, however, any withdrawals of contributions to a spousal plan claimed as a tax deduction by a contributing spouse made in the year the contribution is made, or in the 2 calendar years prior to the year of withdrawal, are taxable to the contributor in the year of withdrawal rather than to the plan holder. In each of 6 consecutive years, a husband contributes $1,000 to his wife's RSP, which he claims as a tax deduction. In the 7th year, there are no contributions, and the wife deregisters the plan. Thus, for the 7th taxation year, the husband includes as taxable income in his tax return sum of $2,000. Contributions 7th year, nil in the 6th year, 1,000 in the 5th year, and then 1,000 in the 5th year. And the wife includes as taxable income in her tax return the sum of $4,000. Contributions made in the years 1, 2, 3, and 4, plus all earnings that accumulated on the total contributions of $6,000 in the plan. Hey, Nereus Hughes, welcome. Mika, keep it professional. There. Okay. Where was I here? Other types of contributions. Some pension income can be transferred directly to RSPs. The following transfers can be contributed without affecting the regular tax deductible contribution limits outlined elsewhere. Lump sum transfers from registered pension plans and other RSPs, if transferred to the individual's RSP on a direct basis, are not included in income and no deduction arises. Yeah, when it's just a direct transfer from registered to registered, you don't normally pay tax. Oh, where are we here? Allowances for long service upon retirement, often known as retiring allowances for each year of service under very specific guidelines. Termination of RSPs. An RSP holder may make withdrawals or deregister the plan at any time. But mandatory deregistration of an RSP is required during the calendar year. When an RSP plan holder reaches the age of 71. The following maturity options are available to the plan holder in the year he or she turns 71. Withdraw the proceeds as a lump sum payment, which is fully taxable in the year of receipt. Use the proceeds to purchase a life annuity. Use the proceeds to purchase a fixed term annuity, which provides benefits to a specified age. Transfer the proceeds to a registered retirement income fund, which provides an annual income, or a combination of the above. RIFs, registered retirement income funds, fixed term annuities, and life annuities available from financial institutions which offer RSPs permit the taxpayer to defer taxation of the proceeds from deregistered RSPs. Tax is paid only on the annual income received each year. Should the annuitant die, benefits can be transferred to the annuitant's spouse. Otherwise, the value of any remaining benefits must be included in the deceased income in the year of death. Under certain conditions, the remaining benefits may be taxed in the hands of a financially dependent child or grandchild. If named as beneficiary, the child or grandchild may be entitled to transfer the benefits received to an eligible annuity, an RSP or a RIF. If a person dies before deregistration of an RSP, the surviving spouse may transfer the plan proceeds tax-free into his or her own RSP, as long as the spouse is the beneficiary of the plan. If there's no surviving spouse or dependent child, the proceeds from the plan are taxed in the deceased income, in the tax in the year of death. Advantages of RSPs. The following are some of the advantages provided by RSPs: a reduction in annual taxable income, during high taxation years through annual tax deductible contributions, shelter of certain lump sum types of income from taxation through tax-free transfer into RSP, accumulation of funds for retirement or for some future time, with the funds compounding earnings on a tax-free basis until withdrawal, deferral of income taxes until later years when the holder is presumably in a lower tax bracket, opportunity to split retirement income using spousal RSPs, which could result in a lower taxation of the combined income and the opportunity to claim 2,000 pension tax credits. Disadvantage of the RSPs. If funds are withdrawn from an RSP, the plan holder pays income tax, not capital gains, on the proceeds withdrawn. The RSP holder cannot take advantage of the dividend tax credit on eligible shares that are part of an RSP. If the plan holder dies, all payments of the RSP to the plan holder's estate are subject to tax as income of the deceased, unless they are to be received by the spouse under certain circumstances, a dependent child or grandchild. The assets of an RSP cannot be used as collateral for a loan. Okay, we're almost done this chapter. We're on 6-17 still. So close. Okay. Really, really close. So we're going to leave it there. I will write in beauty. It's just, there's a lot of chapters, a lot of reading. So you just got to chunk it out. So that's it for this morning, and then I'm going to do more later. So I'll let you guys go. This was a short live. But again, I'm going to try and do some studying at lunch too while I eat, just to get it done. Yeah, I won't have a ton of time at lunch, but hey, if I'm doing like 30-minute chunks or basically 20 to 25-minute chunks and then a longer session in the evening, it'll add up. So have a great rest of your day, Mindset Fam, and I'll see you guys.